What's up guys, welcome to the new video lessons of the week. So today I'm gonna go over couple trades that I did. I think I made around close to 60,000 to 70,000, anywhere between. So today I'm gonna go over couple trades that I did. I think I made around close to 60,000 to 70,000, anywhere between in around this week plus Friday. So well, let's get into it. So I think, let's see, the way I posted, I lost 4,000 in October 4th, made 26,000 October 5th, made 10,000 October 8th. I think October 9th I posted, I think it was 5,000, then 20,000, 23,000 on October 10th, and today I didn't trade anything. So I think the key thing is do not trade anything you don't know, because if you are trading anything you don't know, you're purely gambling. Once you start gambling, you will get into that. Once you take a loss, you will get into that how to win back circle. Then you start overtrading. Overtrading is, of course, anybody know, is the wrong action to do when you are trading the stock. Will give you more losses. Sometimes can blow up your account. So now let's get into the tickers we're gonna talk about. So VTVT and GTXI. The reason why we track trades is because we want the average spiking percentage if we're shorting something without resistance, something like gap up short. Typically they push about a little bit between 20 to 31%. And now sometimes it fluctuates a little bit. Now there's a lot of more details goes into volume exhaustions and how to actually figure out people's mentality. Now gap up short is a little bit difficult because sometimes can go straight bust your risk. And you have to be really careful because you don't have any resistance to your risk into only intraday. And that's something you have to be a little bit more practicing, and I don't really suggest for beginners to short into it. Once you see this pattern a lot, start getting used to it, then go for those gap up short. Now for longs, people are asking me how to dip buy. Dip buying is a very tricky thing. It's a correlation behind all the mentality, because larger caps are harder to drop because they actually have fundamental into it. So once you see a massive drop, if it's trading massive amount of volume, typically bounce back. So shorting into massive panic on a larger cap, it's not very good. Now I rather dip buying big panic on a larger cap than shorting into it. Now, as I mentioned in my trading technique, about the fundamentals or the psychology behind gap up short or bounce short, all those things are a must learn, because once you figure it out, the majority of people's psychology, you can use that psychology to counter different strategies. Sometimes it doesn't work. Now there's always about that 10 to 15%, and the stock goes irrational. Stock is not behaving what you're expecting of. Then cut your losses, and once the stock comes back down, and then if it falls back to resistance, then short it again, because people thought it was a breakout, turns out to be a fake out. So on VTVD, stock had a massive run in the October 3rd, and there's many bounce short comes back in 1, 2, and 3, and 4. Now for all those hypes, people are looking to get into the front side, and especially on sector hype. Sector hype is really dangerous to get into the front side, because now for the psychology of it, once you survive this hype, you don't short into massive run up, and all those plays bounce short comes in later will be a lot more predictable than just hammering the front side with massive amount of volume. Because if volume comes in and something like 50 million, 100 million shares every day, the stock becomes irrational, it becomes really crowded, and it's really hard to predict. Once it's hard to predict, it's hard to gain a profit out of it. So all you need to do is just wait until the stock already forms its own resistance, and you can use that resistance to either short or go long. to play different round of strategies, because once you're shorting into something that doesn't have a history, then you don't know what's going to happen, because history tends to repeat a lot more times in the stock market. But if you don't have a history, what are you going to expect? Because you are trading just by using intraday candlesticks, just by using intraday level 2. Although stock doesn't have history, can be easily manipulated. A lot of shares being traded, people don't know what they're doing, and it's really hard. So on IGC, MBEV, VTVT, all those heavy volume traded stocks, just wait until all this hype is over. Then either you can swing for it, either you can use the bounce short, whatever you want to do. And it's much more predictable than shorting into the front side. So GTXI, it's an all-day fader. They actually get massive stuff into those 330-ish area. Now the reason to track gap up short, the reason to track trades, is to figure out where is your entry supposed to be. Sometimes gap up short does not push, they fade straight back, and you feel like you missed opportunity and you want to chase into it. All those things that you shouldn't do, because if the stock doesn't meet the perfect criteria, don't ever get into a stock, because that's where the mistake comes from. If you're shorting something without the support, without resistance, it's going to be even more dangerous. So trading the market, difference between gamble and trading the market is you have an edge in the market, you have a winning percentage in the market. You know you have to know what you're expecting. If the stock doesn't behave what you're expecting, then what's going to be the results. So you know exactly what's your plan, and in gamble, you don't know what's going to happen. So this is the difference between the market. You need an edge to be able to become consistent profitable in this market, because for now, market has slowed down for a little bit, and all those weak sectors already died. They formed around 100 million resistance, sometimes even 50, 70 million resistance. So for now, play off the resistance is the safest thing to do. Now let's get into tomorrow's play. AXAI is trading small amount of volume, and hopefully can extend a little bit tomorrow. Now I don't have a plan on this because it doesn't really have a history. So that's for ATXI. For all those heavy volume traded ticker, hopefully they can offer some bouncing to it. And let's talk about dip buying on some of the tickers. As I mentioned, dip buy strategy works better than heavy volume with big market cap. So let's get into now. Right around here, the stock went from 6 to 14. Now stock is trading 100 million volume on that day. Once the stock starts panicking, it's really easy for stock to hold its dip and start breaking out again, because as larger caps, as I said, dip buying into larger cap has high winning percentage, also on the breakout as well. And since the stock is trading over 100 million shares, that's even more profitable on something like NIO. So next time when you see the same thing, panic, they always bounce really hard. Panic, they always bounce really hard. And especially on larger caps over $1 billion market cap. Now once you start forming resistance, then it becomes a short. And since every day, every bounce is failing and start downtrending. So don't dip buy into something that has a history of a big resistance, but you can dip buy in something that's trading massive amount of volume, doesn't have a history. Stock has a larger cap than we used to trade. If it's over 1 billion, and all those morning or midday parabolic panic, they are easier to hold, and that's one of the really high winning percentage dip buy pattern. That will be my thoughts for all the plays that I did this week. Hopefully you learned something from this video lessons, and I will see you guys in the next video.